Hi everyone, Nick here. I was helping a family member construct a portfolio at Fidelity and the question came up about which bond funds to use. There are so many choices for bond funds it can be overwhelming and even confusing. Many investors choose bond funds that offer a higher return. On the surface, this seems like a good decision. After all, who doesn't want a higher return? In preparing this video, I thought about what would provide you the most value in navigating bond funds. There are two important concepts I will cover. First, I am going to walk you through the basics of how to evaluate and compare bond funds. Then I will explain why I think it's a bad idea to go after higher returns with bonds. I view it like trying to pound a nail with a screwdriver. These two concepts will help you make a more informed decision for your portfolio. All I ask is that if you get value from this video, smash the like button to support free financial education. I'm going to use two Fidelity mutual funds to illustrate my point. The same way we analyze these funds will be useful for comparing other bond funds. The concepts apply whether you're considering adding high-yield bond funds to your portfolio or comparing other bond funds. I decided to use these two Fidelity funds since they seem very similar on the surface and were what confused my family member. The first is FXNAX, their US Bond Index Fund. The second is FTBFX, their Total Bond Fund. What's the difference between these two funds? Most people would start by looking at the performance of the funds. The US Bond Index Fund has a 30-day yield of 1.33% and has returned 3.42% annually over the past 10 years. The Total Bond Fund has a 30-day yield of 1.92% and has returned 4.2% annually over 10 years. At this point, many people might select the fund with the better performance. This is the exact scenario that came up when I was helping my family member construct their portfolio. I recommended they use the US Bond Index Fund. They asked me, well, why not use the Total Bond Fund? The snapshot shows the Total Bond Fund has a higher rating, higher returns, and the same risk on the risk meter. It's a good question, and that is why I made this video. Now let's start by evaluating the key differences between these funds. The US Bond Index Fund is a passive index fund. It just tries to match the overall return of the US bond market. The Total Bond Fund is an active fund, meaning the fund manager is trying to select the best bonds for the portfolio. This adds some risk to the active fund, since most active funds underperform their benchmark over long periods of time. We can see this difference in the fees. The US Bond Index Fund has a fee of 0.025%. The Total Bond Fund has a fee of 0.45%, which is 18 times higher. Paying 0.5% fee is very high for any investment, especially when the fund is returning less than a 2% yield. It could theoretically be worth it if the investment manager is able to get a better overall return. Now we'll look at duration. Duration reflects the interest rate risk of the fund. Let's say you owned a $100 bond that yields 2% for the next 10 years. Each year, you would get a $2 interest payment. After 10 years, you would get your $100 back. Now let's say the interest rate for 10-year bonds went up to 4%. If you tried to sell your 2% bond to someone, nobody would buy it for $100. You would have to sell it for less since interest rates are now 4%. In this case, you would have to sell your bond for $50 since the $2 per year return from your bond is 4% of $50. The inverse happens when rates go down. Existing bond prices will go up. If your $100 bond yielding 2% matured in 1 year and rates went up to 4%, you would only have to discount it to about $98. This would still give the person a return of $4 and their principal back after 1 year. This whole concept is a little complicated until it clicks. The duration of a bond fund reflects this risk. The longer the duration, the more the price of the fund will move when interest rates change. The total US bond index has a duration of 6.05 years. The total bond fund has a duration of 5.91 years. They have almost the same risk to changes in interest rates. Now let's look at the composition. There is a lot to digest on the composition page. We won't go into all of the details, just what I think are the most relevant. Let's start with the fixed income style map. This helps us quickly understand major differences in these funds. It has two dimensions: interest rate sensitivity and credit quality. Interest rate sensitivity is basically duration. We have limited on the left, which may be called short duration. In the middle, we have moderate, which is also called intermediate. And on the right, we have extended, also called long. You may see these in the name of some funds that target bonds with certain sensitivity to interest rates, like an intermediate term bond index. Both of these funds target intermediate duration, which is moderate in this style map. On the other axis, we have credit quality. Credit quality is determined by different rating agencies like Moody's or Standard & Poor's. They evaluate different criteria of the bond and issuer to assign a quality rating to the bond. They range from ratings like US government and AAA, which are considered very high quality, to B and below, which are low quality and often called junk bonds. This is where we uncover the major difference between these funds. The US Bond Index Fund has an overall credit quality of high, while the total bond fund is medium. Up until now, these funds looked very similar. Let's shift to the breakdown in credit quality. This basically shows the quality in decreasing order. US government is often considered risk-free as they can print money to pay you back. As you go down the list, you get into junk ratings. You can see that the US Bond Index Fund is basically all high-quality bonds. It has some A and BBB bonds, which are more of a medium credit quality. The total bond fund has a lot more bonds in the BBB rating and below. This reflects higher risk in the total bond fund, which is why it provides a higher return. I'm going to blow through a couple other metrics quickly. You can look at them in more detail, but they just provide additional evidence of the higher risk in the total bond fund. Portfolio diversification shows that the total bond fund has a much higher exposure to corporate bonds, cash, and less mortgage-backed bonds, and it even dabbles in derivatives. Asset class diversification is only shown for the total bond fund, as the US bond index is all investment-grade bonds. The total bond fund is only 74% investment grade, then 17% high-yield bonds, often called junk bonds, 4% emerging market bonds, and 5% cash and other. Regional diversification shows the US Bond Index Fund is 92% in the US, which seems odd considering it's a US bond index. This is because these foreign bonds are actually Yankee bonds, which are bonds issued by a foreign entity in the US, and the bonds are denominated in US dollars. The total bond fund has 19% in foreign, and if you dig in deeper, has hedged foreign currency exposure, which is why we see some use of derivatives. There are many more interesting details for composition, but the main takeaway is risk. The total bond fund gets a higher return because it has higher risk. This should be expected. This may not be immediately obvious, as the risk meter makes it look like these funds have the same risk. Let's move to the Performance and Risk tab. The volatility measures are often used to evaluate the risk of a portfolio. The standard deviation is higher for the total bond fund, indicating the price fluctuates more. Next, let's discuss the Sharpe ratio. This is where it gets more interesting. The Sharpe ratio is a measure that attempts to show the risk-adjusted performance. You can think of this like risk efficiency. If you take on extra risk, you want to be compensated for it. Let's say there are two funds that have the same risk, but one has a higher return. The fund with the higher return would be more efficient as it delivered better returns with the same risk. It would have a better Sharpe ratio. In this case, the measure suggests the total bond fund is more efficient. These are the core criteria I look at to evaluate bond funds. At this point, the data seem to suggest that the total bond fund will boost the return by taking a little more risk, and that it is reasonably efficient from a risk-adjusted return. However, if you recall from the beginning of the video, I said I believe going after a higher return with bonds is like pounding a nail with a screwdriver. Why do we put bonds in the portfolio in the first place? Is it to seek a higher return? Generally not. It's generally to reduce risk of the portfolio. If we're going to take extra risk and go for a higher return, we typically do that with stocks. Stocks are generally far more efficient than bonds when it comes to a risk-adjusted return. Not only are stocks more efficient from a risk perspective, they generally have more favorable tax treatment as well. When we think of which tool is best for which job, stocks are generally best for taking risk to get a higher return. Bonds are generally best for reducing risk and capital preservation. It may seem counterintuitive to choose a bond fund with a lower return and other characteristics that seem less favorable. Let's go over to Portfolio Visualizer to illustrate the point. I will use a portfolio with 60% stocks and 40% bonds. Both portfolios will use FXNAX, Fidelity's U.S. Stock Index Fund, for the stock exposure. For bond exposure, the first portfolio will use FXNAX, the U.S. Bond Index Fund. The second will use FTBFX, the Total Bond Fund. The data only go back to 2012 for these funds, since Fidelity Index funds are pretty new. We can see using the actively managed Total Bond Fund boosted the portfolio return by about 0.37% per year. We can see the portfolio has a bit higher risk, with a higher standard deviation and a lower Sharpe ratio. It also has a lower Sortino ratio, which is another measure for risk-adjusted return. Even though the Sharpe ratio in the Fidelity site was favorable for the total bond fund, it is not favorable in this scenario. It provided a higher return, but a worse risk-adjusted return. I am going to adjust the portfolio with the less risky U.S. Bond Index Fund to instead include 68% stocks and 32% bonds. Now, the risk-adjusted return measurements are roughly equivalent. However, the overall return of the portfolio with more stocks was better by 0.63%. This is where using the right tool for the job is important. When choosing a bond fund, always ask yourself, why are you adding it to the portfolio? Are you adding it to reduce risk, or is there another reason? I would only include bonds in a portfolio to reduce risk. So I prefer a single, low-risk bond fund. It keeps the portfolio simpler. FXNAX, the Fidelity US Bond Index Fund, is the only bond fund in my portfolio. I also like VBTLX from Vanguard. Stocks have historically been far more efficient at delivering a higher return per unit of risk. They have also been better from a tax perspective. This isn't guaranteed to be true in the future, but this is the strategy I use. Some people will take this a step further and just use a treasury bond index in their portfolio. This has even less risk than the total bond index, and I believe this is also a reasonable strategy. I thought about doing this with my portfolio, but I like having the broader exposure of the US bond index. They are still all high-quality bonds with very low risk. If you want to learn more about my portfolio, I use the 3-fund portfolio. I believe it is the best portfolio for most investors. It is extremely efficient when it comes to your time, taxes, fees, and the risk-adjusted return. It is very well diversified, easy to manage, easy to adjust to your goals, and easy to understand. It is a very elegant solution to the complex problem of asset allocation. It is constructed using similar analysis that we used in this video. I made another video covering it in more detail, which I'll link up here and down below. One extra thing to note about Fidelity mutual funds. They have great index options, but they also offer actively managed versions of these funds. Often, the actively managed funds seem like they might be a good option since the returns are equal or better. You can see that with the 2 bond funds we compared in this video. The actively managed fund seemed like it was better, but when you consider overall portfolio composition, it was not. You can also see this with their other funds, like the target retirement date funds. I noticed that the actively managed versions of these funds typically take on higher risk to compete with the return of the lower cost index versions. On a risk-adjusted basis, the index funds will generally be more efficient. If you want more risk, use the right tool for the job. Active management risk is almost always the wrong tool. Thanks for watching, everyone. Share your bond investing strategy in the comments down below. If you got value from this video, make sure you smash the like button, then subscribe so you don't miss future content. Later.